Joining us today is Citigroup Chief European Strategist Jonathan Stubbs. It's a pleasure to have him with us here this morning, of course. Jonathan, I mean, you're pretty much reassured by the test. Why is that? You pretty much agree with what Trichet just said. Yeah,
I think this has been a key issue, obviously, for European and global investors for some months now. And what the tests have been designed to do is to reassure markets, firstly, and secondly, to shore up confidence in European banks. Now, many analysts and investors will have some issues with the definitions of capital on the one hand, also the breadth of the test. They've only tested the trading books, not the banking books. But I think the level of disclosure, especially relating to what banks own in terms of sovereign bonds, and the transparency and bringing together these tests across the whole of Europe on a consistent basis, generally is positive.
But that's not to say, though, that we should stop worrying about these banks, correct?
No, I think there's no silver bullet here, but this is a step in the right direction. I think similar to the developments we've seen on European policy over the last few months with the establishment of the Stability Fund. I think these are necessary and important steps to reassure and to recover confidence in the European banking system. So overall, from a market sentiment perspective, I think it's positive. Also, as you mentioned, European banks are pretty strong yesterday, but also share prices and bank credit has been pretty strong over the last few weeks into these tests. So the market is giving a half a thumbs up already in terms of what the tests mean for investor sentiment.
Is it then a good time to be buying into banks?
Well, very interesting question. Banks look cheap on lots of the traditional metrics, price to book, etc. Perhaps what happens from these stress tests, with all the disclosure we now have, investors will be better able to differentiate between the higher quality and the weaker banks, and maybe we get some of that starting to price in. I mean, we see some of the stronger banks as looking cheap relative to the market compared to history. So we'd be very happy advising investors to buy banks, but to be selective and to focus on those banks with the strongest balance sheets firstly, and second with the better growth footprints, which is typically the bigger banks with international footprints.
Taking a look at the economy as a whole, some people are talking about the threat of a double dip. You don't share that view?
I mean, double dips are pretty rare, first of all.
It doesn't mean it can't happen.
It doesn't mean it can't happen. We've seen it over history, so we can't rule it out. Globally, we think a double dip is unlikely, and we cite reasonably low levels of inventories, a steep US yield curve as supporting evidence in that. If we are going to see a double dip anywhere, Europe is right in the spotlight, given the very low level of growth we have at the moment. Anyway, 1% GDP growth this year and next expected, and also the sovereign risk which are elevated in Europe. Having said that, to see a double dip across the European region, you probably need to see the German economy break. Our economists have been upgrading GDP forecasts for Germany over the last few months, not downgrading. We're expecting 2% GDP growth. The German economy will break if global trade fails, or if the sovereign crisis re-accelerates, and especially if Spain joins Greece in being an incremental point of weakness. We think both of those are unlikely. So double dip potential in Europe, yes. But that double dip, we think, is focused on a few of the economies, especially in the periphery. And our economists are looking for economic contraction in Greece and Spain this year and next, for example.
The austerity measures, what effects are we expecting?
Well, I mean, we have fiscal deficits which are unprecedented in peacetime. So, we need something to happen. We need fiscal deficits we need fiscal consolidation. We're not going to see growth or inflation to the extent we need to repair fiscal balances. So we have fiscal cuts. We have an era of austerity, and that impacts some countries more than others. And again, I think this is the most important point. Europe is not one economic bloc. We have two-speed Europe, and the austerity measures that we're seeing, especially again in the periphery in southern Europe, some of those economies that benefited most in the boom times of the last 10, 15 years, are very painful and are going to provide a very serious headwind to growth.
Given what you said about the results of the stress test and the general economy as a whole, we've not seen confidence return in Europe. When do you see that changing, reversing?
Yeah, I mean, confidence is a fickle thing. Investor confidence is a fickle thing, and I think it's interesting this year to see European equities perform in local terms in line with US equities, for example. So the weaker macro environment in Europe hasn't necessarily hurt the equity market performance. Part of that is due, I guess, to a lot of European companies being international plays. So they're exposed to nominal GDP outside Europe as well. I think also from a corporate perspective, we are starting to see a few deals coming back. I'm sure you've been talking about that here in Asia, but also in Europe over the last few weeks. We see that as an encouraging sign.
I'm afraid we have to leave it there. Citigroup's Jonathan Stubbs joining us here in Hong Kong.